recording is now going live, so that will be available to be seen on an e-shot, which we will send out after the recording, and it will be available on our YouTube channel as well. So that will follow shortly. So if I could just give a brief introduction. My name is Chris Elias. I'm a relationship director with Thrings. I'm not a lawyer by trade. I'm a banker, so no tricky legal questions for me. I'll leave that for my two colleagues who are joining me on the panel today. Today's webinar is the second in the series of our Business Health Matters webinars, where we're trying to focus on a number of issues that our clients have raised throughout the pandemic. They've raised with us through our various client groupings, and what we've tried to do is sort of bring all these queries and questions together under various headings, and then explain them and expand them in a webinar scenario, so people can follow the thread of concerns that other clients have had. So I hope you find that very useful. We will be running further webinars, and our next webinar is on the 11th of August, which will be based on commercial property and planning issues. So if you know of anybody who would be interested in those matters, please sign up for that, or sign up for it yourself. So I'm sure that will be very interesting. Today's webinar is based around cash flow issues, that are clearly very important in terms of the crisis that we've just gone through. And today we have two panel members. First up, we have Simon Hall. So, Simon.
Hi, Chris.
Good. Simon, also known as Harry. So, if I do mix my names up, you'll know why. So, Simon is a partner in the corporate and banking team at Thrings, and specialises in advising both borrowers and lenders in terms of facility agreements, facility documentation, security arrangements, etc. So he covers a whole gambit of banking facilities, and he really has seen things from both sides of the coin, so to speak. So, despite his youthful experience, got a wealth. He's youthful outlook. He's got a wealth of experience in the sector. So great to have you on board, Simon. Looking forward to your presentation a little later. We also have Ramona Derbyshire with us as well. Wave from you as well, please, Ramona. Thank you. Very good.
What am I also known as, Chris?
We'll tell you that later. So anyway, Ramona is also a partner in the Commercial Litigation and Disputes Resolution team. And Ramona returned from annual leave yesterday, so she's really pleased to be thrown into the deep end in a webinar on the second day back from annual leave. But welcome back, Ramona.
Thank you.
Ramona acts for a variety of clients, from SMEs to large multinationals, and if there's one word that you'd use to describe Ramona, it would be commercial, I think, Ramona. Always looking to get a commercial resolution in terms of cost effectiveness and a quick solution to a problem, really, rather than running into lengthy debates. So this will be an interactive webinar. There's a Q&A slot at the bottom of your screen there. So if you've got a question that you'd like to raise at any time during the webinar, please fill in that question, and what we'll endeavour to do is collate all those questions for the end of the webinar and answer them and pick them out as we can there. If there's not time, we will follow up at a later date, or we will try and address your questions personally with you after the webinar. Now, there will also be a poll in each of the individual sections, so just to get a little bit of sort of online feedback as we're going along, really, just to get people's experiences from what they might have encountered over the last couple of months. So again, very simple to use, but very informative, certainly from our perspective in terms of feedback. So that's the outline. In terms of running order, I'm sure we'll be finished well before the published time of 5 o'clock, but hopefully you'll enjoy this interactive webinar. So without further ado, Simon, we'll crack on with you, I think, really, in terms of looking at cash flow issues. I hope you're sitting comfortably there. I think we've heard lots of stories in the press and in the newspapers of businesses struggling for cash during COVID. So If you're a business and you're having funding problems due to COVID issues, what should you do? What's your course of action?
Yeah, hi there, Chris. Well, I should firstly say thanks for having me on your show.
You're welcome.
Edition, it's good to be on. Absolutely, as you say, the impact of what's gone on since the end of March has been extensive, hasn't it? And cash flow has obviously been imperative for all businesses, and we've seen that a lot. And really, the first port of call, as in any time now, no different to any other really. The first port of call is often to your existing lenders. So where you've got an existing relationship, it's keeping in touch with them, picking up with them. It might be you've got existing facilities and they can help you out in terms of repayment holidays on your loans. They may be able to soften financial covenants to ease pressure that way, and also permit further drawdowns if you've got headroom in your facility. So, as I say, that's always the best and first port of call when you've got those cash flow issues. And certainly that's something we've seen from clients and businesses since March, that banks actually have been, really sort of tolerant and helpful to them. And I know that's been quite widely appreciated. So as I say, that's the first sort of step. After that, obviously, everyone's heard about the various government initiatives that have been put in place, the CBILS arrangements, so the Corona Business Interruption Loan Schemes, a variety of facilities available, depending on the size of the borrower. But that's obviously where a lot of people have headed next.
So what are, you mentioned the word CBIL? It's a word that a lot of us have heard. So what are the key features of a CBIL loan? Yeah,
so if we first take the example of the small and medium-sized business, the SME facility that's available. Now that's applicable to businesses of turnover of up to £45 million. The facilities they can potentially get their hands on is up to £5 million, and that can be across a range of facilities. Term loans are potentially up to 6 years, whereas overdrafts, invoice discounting facilities, anything up to 3 years. Obviously, there's certain criteria that should be met, which I think we'll come on to later. But when you're applying to the banks, again, like any other time, it's important to have good quality information you can put to the bank. The other key components of that type of scheme is the government obviously are guaranteeing 80% of that facility, so that's really useful for the lenders, and that's helped them get the money moving and get liquidity out there. If I also touch on that, the really important point to make there, clients must be aware of, whilst the government are backing 80% of, guaranteeing 80% of any facilities provided, that really has no impact on yourself as a borrower. So all the clients out there, they are, as ever, 100% liable for any loans that are made, including under any security, so personal guarantees, etc. And the lender will be required to exhaust those avenues before actually their last resort is the government and their 80%. So that's a really important distinction that people need to be aware of. I guess just finally touching in terms of helping cash flow, there's no interest payments in the first 12 months for those loans. So again, another really useful sort of tool. Security, anything up to 250,000, there's no new security is needed. If there's any in place already, that will remain. At the moment, the scheme, as I understand it, is available to the end of September. So obviously there'll be people out there that have already made applications, but if they haven't and they're thinking about it, then obviously it's really important they get that in as soon as possible, because the current deadline is in September.
I think that's it. I had a couple of conversations yesterday, Simon. There seems to be an element of confusion about that as well, really, whether you've got your facility agreed by the end of September or whether it's been drawn down by the end of September. So that's an aspect where we're doing a little bit of research on at the minute, and certainly something that we will be looking to follow up on as well.
Yeah, absolutely. Yeah, and then so that was the SME facility I touched on there. Just for some other ones for people to be aware of, the sort of whole spectrum. Small businesses, the bounce back loans has been something people have seen in the press. This allows small businesses to borrow up to £50,000 based on a maximum of 25% of their turnover. Now, one issue that actually arises there is for startups with very little trading history or actually pre-revenue businesses. 25% of turnover is not much help to them. So again, it's had mixed reviews in terms of its use, that facility, but for some it's obviously been really helpful. The government guarantees 100% of those loans. Again, no payments in the first 12 months. And I think that has been a really successful facility for a number of businesses, certainly hospitality. It's something that's seen a lot of take up. If we then move to the other end of the spectrum, you've got the coronavirus, the large business interruption loan scheme, and that's for businesses with turnover of over £45 million. And again, they can get up to £200 million, but capped at 25% of their turnover. So that's kind of the whole ambit of the facilities available.
That's brilliant. So what I technology allowing, what I'm going to do now is endeavour to run a quick poll just to see what sort of feedback people have had in terms of possibly using CBILS themselves. So I shall just click this and I shall run this poll. So that will be ticking along over the next couple of minutes. So if you can answer those polls, that will be really useful for us in terms of some feedback. So I suppose what I thought I would probably do at this stage really is in terms of the sort of loans which have been granted. I've made a couple of calls around the banking sector of late, just to get a feel in terms of volumes that people have been doing, and it's quite staggering, really. One person, one senior corporate banker that I spoke to, advised me that within the last 2 months they'd done virtually 4 years' volume of loans in a 2-month period, and so that's a staggering amount of money that the banks will have been putting out under these various schemes. Another told me that they doubled their own lending book, their own balance sheet lending book in a 2-month period. But again, that is millions and millions of pounds which have been going out under these schemes. Quite incredible numbers, I'm sure, when they all eventually get reported. From a banker's perspective, I would always say that if you're approaching a bank for these sorts of facilities, be certain when you go, that you're eligible for in the first instance, really, because there's nothing worse if you turn up to have a conversation about a funding agreement, and if you're not actually eligible for the scheme, you're going to waste everybody's time. Banks are still totally interested in viability, so they will be absolutely certain that you can, that they trust the management, they trust the business, that you're a company that they want to support, and you can do that in a number of ways, really. A couple of things are fundamentally important from my perspective, with my banking hat on. Keeping regular contact with your bank. There are people out there who will say, I'll speak to my bank when I need to. When you need to might be too late. Always keep in contact with your bank. Have regular meetings if you can, even if it's just to chew the fat. Keep them up to speed with regular financial information, so they're fully aware of what's happening in the trading line. Even if it's bad news, you're better to go with bad news and explain why it's bad news and what you're doing to adjust the situation. So be very mindful of that, and never hide a problem, really. Banks don't like shocks, so if you've got an issue, get it out on the table quick, and you're more likely to have a positive response from it and a better experience. So we've talked about CBILS and the various loans. Sometimes, Harry, the devil's in the details with facility documents. What sort of things should we look out for in terms of common terms in respect of banking documents?
Yeah, we thought it might be helpful just to elaborate on a few of the sort of terms you get bandied around, specifically in a banking context, that might be helpful for people. So obviously in any term loan, any loan agreement, facility, the repayment of capital and interest is absolutely fundamental. So obviously that's often the first port of call. But other areas that you, as I say, you may have heard referred to and wonder exactly what we're getting at there. I thought I'd run over. So conditions precedent, and that is, if you like, a shopping list of documents and items that a lender will want to see before they'll permit drawdown. So often very practical things like board minutes, shareholder approvals, insurance documentation, and accounts. Then we get on to maybe covenants. So you get different types of covenants. So they might be sort of information sharing covenants around monthly, quarterly accounts and reporting. It might be their end of year accounts and obligations to provide them to the bank within certain time periods. Other covenants might actually place restrictions on the business. So it might be restrictions on capital expenditure within a period, types of action that can be taken in terms of acquiring other businesses or selling parts of your business. Other examples, there may be certain restrictions around payment of dividends to ensure not too much money is being taken out of the business, or negative pledge is another term people might have used, which is basically preventing any other security being granted over a company that might jeopardize that initial lender. A very specific type of covenant that we also see and is really important is a financial covenant. And this is something that is very often included in loan facilities. And if you like, they act as an early warning signal to the lender. The business is required to stay within certain financial parameters, and if they do so, then everything continues. Examples of what those might be: it might be interest cover, which seeks to measure operating profit against interest costs and finance charges, so checking on the company's ability to repay the cost of any borrowing. Leverage, which measures the debt against operating profit, so making sure that's not getting out of proportion there. These are really important terms, the financial covenants, and we'd always recommend you go through those in detail, in particular with your accountants, given their knowledge of the numbers in relation to your business. And I say they're so important because actually any breach of those could give rise to a default under your facility that a bank could actually use to seek enforcement, and they're protecting their interests there. So that's why that's there.
On that score, so I'm just a little bit of anecdotal evidence that I had recently, where a bank had agreed a facility under the CBIL scheme with covenants, and they felt that was the maximum amount of the funding that they could go to, and the client of the bank then went to another third party to get additional funding, and of course in doing that, whilst the level of debt from the bank was able to satisfy the covenants, by taking on the additional debt, which they thought was a good thing, that has potentially blown a hole in their existing covenants with their main banker. So just be very, very, very careful in terms of the overall quantum of the debt and where you get your facilities from and how they impact on other lines.
Yeah, absolutely. That's a really, really good point. And I guess finally, everybody knows with lending their security, so that might be legal charges over property, it might be a debenture over assets of the company, and maybe even personal guarantees. Obviously, shareholders, by their nature, want to resist that as far as possible, but sometimes it's a necessary evil, if you like. But again, if you take advice, then obviously at least you're informed and you know exactly what those obligations are.
Okay, so if a client has exhausted all forms of debt funding that they could possibly look at, are there any other areas or avenues from your experience that they could go down to generate future cash to support themselves?
Yeah, so I guess once sort of traditional bank lending has been exhausted, the other area that a company may look to is investment. So obviously with bank lending, you're actually, there's no impact on your shareholdings and your equity, but in terms of investment, you may be able to get much needed investment in your company for working capital, etc., to ease that cash flow. But actually, in return for that, you have to give up some of your shareholding. So not always something you want to do, but it might actually become a really positive thing. It might let you get through a current difficult period like now, and it might let you invest in the business and get to the next level. So again, again, just going to touch on a few different types of investors you might see out there, just to add some familiarity to when you hear these terms. So one term you often hear is an angel investor. These are typically high net worth individuals who have got experience of investing in maybe a certain type of business, a certain marketplace where they're comfortable and they've got experience. Often, actually, the angel investors will look to benefit from tax reliefs that are out there. So people may have heard of EIS or SEIS, which are government tax schemes which make investment in these companies really attractive to angel investors, because they can get for SEIS, which happens at really early stage life cycles of a business, up to 50% tax relief on their investment, and EIS up to 30%. So you can see that that's really important for them. And then moving that forward, if they hold those shares for over 3 years, they actually, at the moment, they don't pay any CGT, so no capital gains tax, which again is quite welcome. If I sort of briefly touch on the typical terms you might see in an investment, often you may hear about a convertible loan note. So this is where a loan will be made, and instead of taking equity directly straight away, an investor will actually remain as a creditor of the business with a loan in there. And that helps them because they can extract their money quicker if the business were to take a downturn. So not so good for the business, but good for the investor. The one reason an investor might not like that approach is because they would actually not qualify for EIS. So you can see there's a bit of a conflict there.
Okay.
In terms of, oh, sorry, Chris.
No, I was going to say so that there's a wide variety of investments out there that people could possibly look at. Then Simon, I think I'd perhaps rather go into them all at the minute. Perhaps those are something that we can sort of pick up on in terms of the e-shot that we follow up on. I'm just conscious that time is marching on us really. But I'd just like to just cover some of the polls responses that are in now. It's just interesting to see that in terms of the who's applied for civil or government-backed support, 30% of respondees, 43% of respondees have applied for loans. So that's interesting. But a third have, two thirds haven't, and some more in progress. In terms of the ease of the process, I think it's fairly equal across the board, really, in terms of third finding it easy, third finding it okay, third finding it difficult. So probably a little bit in the middle there. And then in terms of success or otherwise, only 9% of respondees didn't have a positive outcome at this stage. So that's quite good news as well, actually. So, but again, those are sort of some information that we'll share later. So thanks, Simon. Appreciate everything that you've said there. And as I say, Ramona, probably if you can take yourself off the mute now, and now you can join the debate.
Perfect. I'm very pleased I haven't had a child run through yet.
I was going to warn people, but no.
There is time.
Yeah, I suppose really one of the most important aspects of cash flow management is debtor control. At the end of the day, you've probably sold some goods to somebody, they've sold them, got the money back in for them, and just haven't paid you for some reason. So, what sort of experience our Thring's clients have at the minute in terms of managing their cash flow and debt management?
Yeah, it's interesting actually. At the beginning, when the pandemic started, and certainly once lockdown came in force, we found a very patient client base and actually a sort of landscape of forbearance where people didn't want to either be seen or actually destroy potentially their client base. For example, we act for a large health and beauty manufacturer, and they froze all actions against their customer base, which are hair salons, which of course during lockdown and only up until recently have had a terrible time. And they made it a policy not to take any action whatsoever. So we froze many actions that were ongoing on their instructions. Since life's become a little bit more back to normal and lockdowns eased, we have now seen the opposite, good or bad. And that is a lot of frustration, a lot of people wanting to take very urgent action, almost a bit of desperation in some cases. And I think really the message is every penny counts at the moment. On the flip side of that, practically speaking, we're seeing the courts are in disarray, the county courts are in disarray, High Court's managing a bit better. We're having hearings remotely. I did a 8-day Skype for Business trial, which was absolutely exhausting, but we managed to get through it. And we're having the county court, we're always behind in their post. The county court is well behind in their post now, and we are taking months to hear from them on some occasions. But also we're having very surprise hearings from them. I found out today that I had a hearing, found out at 12 o'clock today that I had a hearing at 2. We said that's not enough notice, Judge. They said, oh, well, and off I had to go at 2 o'clock. I normally would have had a barrister instructed, but no, we didn't have time for that. So that was good fun. But you'll see it is flying a lot by the seat of our pants at the moment in terms of volume of instructions that are coming in and urgency of the debt recovery needed, and then the court process having fun and games.
Yeah, well, so if a client does experience sort of difficulties, chasing up debts and collecting in debts, what are there any sort of legal or statutes that they can rely on to help enforce that recovery?
Absolutely, and we've got a little friend from Europe, at least for the moment anyway. Our Act, the Late Payment of Commercial Debts (Brackets Interest) Act 1998 is actually really helpful. I'm sorry, I'm going to be a bit nerdy at the moment because I love this bit of law. Its aim is to compensate for late payment, and any business of any size can apply the Act, which I'll come on to in a minute, what it actually gives you. But as long as it says contract for goods or services, it's not a Consumer Credit Act or a mortgage type arrangement, and your contract doesn't apply for competing provisions. So you haven't already got interest or costs in there. Then you can apply, the Late Payment Act will imply terms into your contract, and it applies 8% above base rate for interest, much more than you'll get in the bank at the moment. It applies a fixed compensation fee per invoice of £40 to £100, sorry, and it also applies reasonable costs. So just to give you an example of that, and forgive me, I'm going to look at my notes so I don't get the maths wrong. Say you've got a £10,000 invoice that hasn't been paid, due on the 1st of January, so it's off the top of my head about 208 days overdue. You can claim late payment interest at £498 and a little bit of pence. You can claim compensation fee of £100 and let's say reasonable cost of £95 for a letter before action. On top of your debt, you can therefore recover £693 extra, which does make debt recovery self-financing if you can use the invoice. So even if you've paid £100 for your legal fees to do your letter of claim, you're well in there with your interest and compensation fee. So even small debts become viable to recover rather than the alternative, which is to write off the debt. Of course, some clients won't like that. They might see it as a bit of a penalty. It's a bit of a hefty charge. So sometimes we advise the clients, if they're of that view, that they could use the Late Payment Act as a bit of a carrot. If you don't pay X by whatever date, we will be applying this, but nice customer, we won't apply it yet because of course you're going to pay up.
Because when we chatted about this scheme earlier, it seemed to me that if you're a client or a customer with a debt to pay and you can't, or you're struggling with it, and you're facing interest penalties of 8%, where in theory you could go to your bank and ask for a receivable, and as Harry mentioned earlier, you can get that 12 months interest free. You could potentially go get your receivable, get your money, repay the monies that you are due, and perhaps go in and even negotiate better terms because you've got cash to do it, and save yourself an awful lot of money by doing that.
Speaking absolutely commercial approach, if your customers are trying to apply the Late Payment Act on you, absolutely try and save that interest and those compensation charges by paying up. I mean, as I was saying right at the beginning, there's this air of desperation at the moment for people to recover their payment. So if you're offering 75-80% now of that invoice, your customer may well accept that, or your supplier, sorry.
Yeah, exactly. Right, before we move on, I'm going to try and endeavour to run a second poll. And there we go. I'm just launching that. And there we are. That's your poll in progress, Ramona. If people would like to follow that up and answer that, that would be smashing.
Thanks, Chris. Be really interested to see what people say to that. So thank you.
Indeed. Now, I've got my teeth in for this next question, Ramona, because it's time for your top tips.
Top tips? Ramona's top tips. I feel
Ramona's top tips on cash flow.
There should be some theme tune there, shouldn't there? Maybe next time. Yeah, so I just had a little sort of brainstorm on my way back from holiday about where we can offer some more practical advice, often to financial directors or credit controllers, or indeed anyone who's got the task in their business of hunting down payment of these invoices. And you may not have a specialist team, of course. So I like to start from the very beginning. And someone told me once that credit control can be seen as anti-sales, and I don't wish to be anti-Salesforce here at all, and obviously there's a fine balance to be struck, but from a legal perspective, from a getting the money in perspective, hopefully these are helpful. So right at the beginning, set up the contract correctly. I can't tell you how many large businesses, let alone the little ones, get their customer name wrong. So when it comes to setting up the contract in the first place, get the customer name right so that we can enforce it later and the defense doesn't come back saying, not me. Also credit check them if you can, credit check them. If it's a business, you can do that fairly easily to make sure that they're not high risk before you even start doing business with them. Ideally, document your agreement in writing. We want to know what you're supplying, when you're supplying it, and how much you're supplying it for, together with how long they have to pay. Then there can be no confusion and much easier if we have to step in to help you recover it. If you don't have provision for an upfront payment, i.e. on delivery, make sure your invoice is submitted ASAP after the goods or services are provided. It just shortens that debt cycle and you can get the money in quicker after you've provided the goods or services. Once it's overdue, I've had quite a few chats with credit controllers recently, and they've started chasing before it's due. So, and it's not chasing in an aggressive way. It's a pick up the phone, just so you know, Mr. X, your invoice is due in 3 days. Do you need another copy of it? Brilliant, you've got it under control and you're about to press pay. Fantastic. And that way you are bringing the whole cycle forward. Obviously, you can apply the Late Payment Act, as I said earlier, use it as a carrot if you want. Mr. Y, if you don't pay this in 3 days, I'm going to have to apply. My nasty lawyer says I'm going to have to apply the Late Payment Act interest. It's going to come up to 600 quid, but I'll drop it if you pay before the end of the week. If there is any hint of dispute, get it in writing. Ask your customer to put it in writing within 7 days so that you can try and put it right if it's a genuine dispute, or if it's a little bit of a obstacle to payment, you'll put them off, and then you know exactly that there isn't a dispute and it can't be a defence later on down the line. And finally, I do find when you're trying to get payment out of someone who may have financial difficulties, or like everyone is slightly struggling at the moment, I do find that those who shout loudest get paid first. And that could well be the case, even if they're heading off down the insolvency route. They won't want you as a creditor to get in the way of it, stuff it up, stuff whatever their plans are. So I do find shouting loudest, be a solicitor's letter, debt recovery letter, your own letter, and taking action if that doesn't result in 7 to 14 days is the best route at the moment to try and get payment. Because of course, you can go through the debt recovery process, get yourself a nice CCJ, and it could be hollow if they don't have the money at the end of the day. So you need to act fast.
Make yourself make a bit of a nuisance of yourself then, really, and get in there and knock the doors. Okay, absolutely. Well, that's brilliant. Ramona, thank you very much for that. Just looking at your poll results, actually, just in terms of the respondees, 75% have experienced late payment of invoices, but only 25% haven't. Quite surprisingly, though, have payment days for your invoices increased since lockdown? 58% of respondees have said no on that one. So that surprises me. I thought that figure would be quite different to that, really. I thought people would be pushing out their turn. So that's a very interesting response from people there. And then finally, Who's made use of the Late Payment Act provisions? 17% of respondees. So perhaps perhaps people don't know about it. I certainly did. I certainly didn't know about it. So you know,
well,
if you want,
interesting. I wasn't entirely preaching to the converted, so that's useful. And sorry for those who knew all about it already, but hopefully there was something in there for you. Interesting that only 17% use it when it's such a powerful tool.
Well, exactly. So if you want to learn more about it, you know who to ask, Ramona, don't you?
Harry.
No, you. Good. Okay. Well, that's sort of the end of things as far as our speakers are concerned. I've just had a quick peek. We've got no specific Q&A which has come through at the minute. If anybody does want to raise a question, please sort of please feel free to do so. Whilst we do that, really, I suppose I'll just sort of wrap up really in terms of cash flow and debt monitoring. You know, cash at the end of the day is the lifeblood of your business. Without cash, you can't buy supplies, you can't pay your staff. It is absolutely fundamentally important to every single business. Please keep on top. Please keep on top of it. Please speak to your banks if you need extra support. They'll always be accommodated, I'm sure, if they possibly can, particularly in the current climate. As far as CBILS are concerned, there is a deadline, 30th of September. So if you are looking to apply, please apply quickly. So a couple of important points there. I'm just thinking that from the panelists, have you had any questions at all that have been sort of thrown at you in recent weeks that you might find it worth sharing with us?
Yeah, one question I get quite regularly is, oh, I've only got, I've got a few debts. They're quite old, and they're not that much. Is there any point in recovering them? And hopefully I've answered that in a little bit in terms of the Late Payment Act, allowing you to make it more self-financing. But also, secondly, you have got up to 6 years in which to pursue any unpaid invoices. After that time, they start dropping off a cliff, so they'll be statute barred if you don't pursue them within the 6 years. But of course, if anyone pays you by cheque and that's dishonoured, that's a really quick and simple judgment that you can get on that. And one thing I haven't touched on today, but happy to answer any questions on it, is once you've got a judgment, how do you actually get your hands on the dosh? And there are multiple ways of getting judgments enforced, from sending in the sheriffs, county court bailiffs, to attaching yourself to property, to attaching yourself to other people's debts or income and earnings. So that's sort of part of the art and craft of the debt recovery personal team in terms of actually enforcing judgments. So just thought I'd raise those couple of points.
Okay. Harry, one question for you, really. How, because obviously the volumes seem enormous of some of these loans. So how speedily have you seen the banks reacting to getting documentation out to you for overview and signature, etc.?
Yeah, I mean, that's an interesting one. In terms of, I think the initial application, the turnaround times are actually really quick, and I think the clients I've heard of have had positive messages. What has tended to take the time is, and again, it's not really the bank's fault. They're trying to do so much in such a short period of time. It's getting that paperwork out has taken a bit longer, especially in the example I saw where there was a bit more to do beyond the term loan. So, for instance, shareholders had loans into the business themselves, and as part of the CBILS loan, those shareholders had to sign a deed of postponement, which means effectively they agree to rank behind the bank and not be repaid until the bank had been repaid. But because those had to be added in, it all took time, and actually, and that's what dragged it out. Not the actual application and assessment itself. It was the follow-up legal paperwork. Probably blame the lawyers. Too much paperwork to get out.
Absolutely. Well, always a good way to end things. Great. Okay then, folks. Really appreciate the time today, and I'm sure everybody who's joined the webinar has thoroughly enjoyed it, found it thought-provoking and informative. As ever, if there are any questions that need following up, please do not hesitate to contact us, and either Simon or Ramona or myself will be more than happy to answer any of your questions. And just to remind you again, our next webinar is on the 11th of August, and that's going to be looking at commercial property litigation and planning issues. So if you can join us for that, we'd love to have you on board. So have a very pleasant rest of the evening and take care. Bye, everyone.
Thank you. Bye.